Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
I'm Rob Black. Let's take a look at market returns this year to see if we can't gain some advantage and insight. Crude oil up 17% year to date, silver up 25.9%, gold up 20.5%. The commodity supercycle is still playing out in 2026 as outperformers compared to other markets. Digital gold, on the other hand, Bitcoin is down 23.8%. There's something to be said for an asset heavy, a real thing versus the digital. Now let's take a look at some markets and see how that tells us what to look forward to in the near future. The Morgan Stanley Country Index All World up 3.8%. The Russell 2000, small companies in the United States, up almost 7%, up 6.7%. And the Dow Jones Industrial Average is up 2.3% year to date, telling us that there are winners in the market, just sometimes outside of the United States, as the S&P 500 is up fractionally for the year, up 0.75%. But the Russell 2000 is beating it significantly, as is the Morgan Stanley Country Index All World. Of note there are stocks that are doing well outside of the Magnificent Seven who are waiting, maybe putting the weight of the world on the shoulders of the S&P 500, because the Magnificent Seven is down 4.7% year to date. Now let's talk about some other issues. 54% of U.S. teens aged 13 to 17 use AI chatbots to do their schoolwork, according to a new survey, including 10% who say they don't get through any or most assignments without extra assistance. That's up from 26% and just 13% in 2023. 13% in 2023, 26% in 2024, 54% today, now in 2025. Obviously the survey, because we are living in 2026. But jumping from 13 to 26 to 54 makes sense. OpenAI has secured a blockbuster $110 billion funding round, valuing the company at $730 billion. Everyone who's invested money in the company, venture capitalists, private equity, founders, they've all made money. When this company comes public later this year, just keep that in mind. There'll be $730 billion of profits, of winners underneath you if you pick up the shares. OpenAI detailed the startup's new multi-year partnership with Amazon, in which the tech giant will initially invest $15 billion and then another $35 billion in the coming months when certain conditions are met. Wow. The levers on this, setting it up for if there's underperformance, a lot of people are going to bail on OpenAI. Big story out. Jack Dorsey's Block is cutting 40% of its workforce, saying intelligent tools have changed what it means to build and run a company. The Cash App and Afterpay revenues were flat in 2025. Morgan Stanley upgraded the stock to buy from hold, citing expanding addressable market. Evercore ISI talked about Block this morning, saying management is explicitly redesigning Block as an AI native organization, embedding automation and efficiency tools across product development, underwriting operations, and customer interfaces. The financial implications are significant. 2026 adjusted operating income guidance of $3.2 billion with a 26% margin sits materially above management's prior expectation at the investor day just a few months ago. That's signaling a lot of confidence that AI-driven efficiencies can expand margins structurally while sustaining or potentially accelerating product velocity. I like Jack Dorsey. I think he's a smart man and he's worth listening to. The reduced headcount should now drive a marked improvement in the gross profit employee metric, which we expect will justify expanded valuation premium. I could go into more analyst conversations about this, but I think I just did pretty well. You're going to see other big tech companies do the same thing. Maybe not 40% of their staff, but did you see how the stock responded today? Up 20+%. You're going to see other companies do this. Wall Street is excited for Block to move forward with fewer humans and more AI. The framing of letting go 40% of your staff echoes Citrini Research's viral outlook from earlier in the week. AI, according to the bearish report out of Citrini Research, will not simply make individuals more productive, but push companies to radically slash headcount and embrace automation. Block expects to take a $500 million in restructuring charges. The market reaction, though, is suggesting investors are more than willing to take the hit for a leaner, more efficient company over the long haul. eBay also announced layoffs, eliminating 6% of its workforce, or about 800 employees. Not nearly as graphic as what Block and its AI ambitions pulled off. eBay has been accelerating its AI-related investments and projects over recent months. The pattern is really, really clear. You're going to see more of this in the coming weeks, months, quarters, and years, all tied towards the Citrini warning of an AI-driven shrinking of workforce actually playing out. Now, I don't think it's that cut and dry. Jefferies cut its price target on CrowdStrike to $500 from $600. That's a pretty big cut on price targets. As a guy who's been following analysts for years, you don't really usually see that aggressively of a pullback in PT's price targets. Jefferies maintained its buy rating on the shares. So this is the revenge of the price to earnings multiple. I like that phrase. The revenge of the price to earnings multiple. The price to earnings multiple. When companies trade above 20 PE and they move into that 25 to 30, they better get everything right. And when they're in the PE of 35 to 40, if they don't get everything right, their stock's going to get hit hard. And that's what is happening to names like CrowdStrike in the software world that is affected by AI. Bank of America reinstated coverage of longtime Costco. Bank of America reinstated coverage of Costco with a buy rating. I like Costco for the long-term patient investor. It's got real assets, food, lawn furniture, TVs, things that we consume as Americans in their stores at discount prices. Plus, they have a subscription model on top of that, which Wall Street loves subscription models. Don't be afraid to own an AI stock like an NVIDIA. And please pay attention. When it falls 20, 30, or 40%, you could balance an NVIDIA with a Costco. Now, again, the PE ratio of NVIDIA, when it's at 40, it's priced for super perfection. When it's at 35, a little less so. 30, a lot less so. Right now, it's in the mid-20s. Now, again, one thing that NVIDIA is going to run into is they're selling semiconductors at premium prices right now. Their Blackwell is selling at premium prices. Semiconductors, they're going to get smaller, cheaper, and faster. The performance is going to continue to go higher. NVIDIA has 2 more cycles to go through before we see price cuts. They still sit where it's a good part of the teeter-totter, where they're still seeing rising prices with the demand. Once demand starts to shirk a little bit, and once Moore's Law catches up with GPUs, which it will, you're going to see a repricing of NVIDIA. Next up, Meta struck a $1 billion AI chip deal with Google as it's struggling to design its own chips. The agreement comes on top of a recently announced partnership with NVIDIA and a chip supply deal with AMD. A Meta deal with Google positions the search giant more directly as a competitor to NVIDIA in its core business of AI processors. Pizza chain Papa John's said it will close hundreds of locations amidst declining traffic weeks after a similar announcement from rival Pizza Hut. That market share gain will increase. When I say you can own a Domino's stock, I want you to buy it on a dip. Warren Buffett's company, Berkshire Hathaway, owns some of it. If it's good enough for Berkshire Hathaway, it's good enough for you to consider on a pullback. I have an event coming up, Beyond the Noise, Navigating Wealth in Uncertain Times, Wednesday, March 11th, 6:30 to 8:30 at the Lafayette Library in Lafayette. Sign up at robblackshow.com. That's robblackshow.com. RobbBlack.com.
These days, retirement planning is more complicated than ever. So set aside Wednesday evening, March 11th, and get ready to learn some strategies for navigating wealth in uncertain times from Stephanie Richman, Rob Black, and Nathan Rogers. This event will focus on retirement income, tax strategies, estate planning, and tax planning. If you're at or near retirement with at least $500K in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves, Social Security strategies, and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. That's Wednesday, March 11th, 6:30 p.m. at the Lafayette Library in Lafayette. Space is limited, so sign up today at robblackshow.com. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
This has been a big week of news. Paramount Skydance now looks to be the winner of Warner Brothers Discovery, taking the prize away from Netflix, with very few media companies left out there. One family is about to control CBS, I think 60 Minutes, CNN, HBO, and TikTok. Paramount Skydance and the Ellisons will buy Warner Brothers Discovery with $24 billion in money from the Saudis, Qatar, and Abu Dhabi. To win over Trump, they canceled Colbert, and they did some other kind of questionable issues on 60 Minutes. A lot will follow on this story in the coming days and months and quarters. Will the deal get blocked and or not? I'm not crazy about the owning CNN and TikTok, as well as CBS News. And if you take a quick look around, Jeff Bezos owns the Washington Post. Elon Musk owns Twitter/X. Being a billionaire gets you the right to buy media companies, and owning media companies gives you the right to form what they say about policy in the United States. To understand why Netflix walked away from the Warner Brothers Discovery deal, you have to understand that Netflix has never been a movie studio. It is a logistics company that evolved into a data company, which eventually became the world's most powerful attention economy. The legend of Reed Hastings starting Netflix because of a $40 late fee for Apollo 13 at Blockbuster. In 1997, Netflix began as a DVD by mail service, while Blockbuster focused on a real estate and impulse buys in aisles. Netflix focused on the long tail. They realized that while everyone wanted the new releases, there was a massive untapped market for niche films in physical stores. Couldn't stock them. The pivot in 2007 was a big one. The Watch Now revolution. In 2007, Netflix did the unthinkable. They began to cannibalize their own successful DVD business. They launched Watch Now with over 1,000 titles. Critics laughed. The quality was grainy. The selection was poor, but Netflix wasn't selling content. They were selling frictionless access. By 2011, licensing costs were skyrocketing as Starz, Disney, they realized Netflix was a threat. Netflix's response was vertical integration. They spent $100 million on House of Cards, not because they liked the script, but because their data showed that fans of David Fincher and Kevin Spacey would binge watch a political drama. They stopped being a middleman and they became the source. By 2020, Netflix hit peak subscriber in the United States. They pivoted again, cracking down on password sharing, introducing ads. While the prestige TV era of HBO, which was now part of Warner Brothers Discovery, was focused on Sunday night appointment viewing, Netflix was focused on a global algorithm. They proved that a Korean thriller, Squid Game, or a Spanish heist show, Money Heist, could be global hits. Netflix's success is built on moving away from the past. Buying Warner Brothers Discovery would have been a move backward into the world of cable bundles and peak TV debt. The very things Netflix was built to destroy. Netflix looked at that price and the 100-year-old library of Warner Brothers Discovery, and ultimately they said, keep it. We don't need it. The Warner Brothers Discovery catalog is a melting ice cube in the age of Generation Z. My kids. Warner Brothers Discovery owns the crown jewels of the 20th century. Media companies. What was the crown jewel? It was things like Harry Potter, DC Comics, HBO, and CNN. In the old world, these were must-haves. In the current world, they're too long. I don't have time to watch, 7 Harry Potter movies? My kids won't watch 7 Harry Potter movies with me. Data shows that Generation Z and Generation Alpha consume media in microbursts. It's 15 minutes. That's the ceiling. Between TikTok, Reels, and YouTube Shorts, the idea of sitting down for a 2.5-hour cinematic epic, like the Batman, it's becoming a niche hobby, not a mass market habit. Netflix isn't competing with HBO anymore. They're competing with Mr. Beast. YouTube's watch time on TV screens has surpassed almost every major streamer. Why Netflix would pay $30 billion for the rights to Casablanca or Friends when the rising generation prefers 12-minute high-octane challenges or 30-second point of view comedy? Warner Brothers Discovery is a library company. They have a massive vault of old stuff. But old stuff requires a high cost of maintenance and residuals. Netflix's real strength is their algorithm. It's better at making cheap, unscripted reality shows. Is it cake? That go viral. Then Warner Brothers Discovery is at making a $200 million blockbuster profitable. I think what we're playing with here is it would have been nice to have doctrine. As Ted Sarandos said, Warner Brothers Discovery was a nice to have. The world has their eyes on Netflix. They don't need to overpay for Batman when they can create their own Batman for a fraction of the cost, or simply license it later when Paramount realizes they can't pay the debt that they took on to buy it. By walking away, Netflix avoided taking on Warner Brothers Discovery's massive debt load. The 10% jump in Netflix shares on Friday is a sigh of relief from Wall Street. Investors want Netflix to spend money on AI-driven personalization and interactive gaming, not on keeping the Discovery Channel and CNN on life support. The next decade of entertainment won't be about who has the biggest movie studio. It'll be about who can integrate with the way Generation Z lives. Netflix is heavily investing in mobile games. Generation Z spends more time in Roblox and Fortnite than in cinemas. If you can't capture a viewer in the first 30 seconds, you've lost them. Warner Brothers Discovery's library is built on slow burns. Netflix is built on the hook. Paramount and Skydance are buying a legacy. Netflix is buying the future. By declining to match the $31 share offer, Netflix has signaled that it no longer needs Hollywood's validation. It has its own ecosystem, its own stars, and most importantly, it has the discipline to let its competitors choke on the high price of nostalgia. In a rare twist for a Hollywood deal making, the loser won. Shares of Netflix surged 10% after hours, after the company dropped its bid for Warner Brothers. Instead of matching the winning $31 per share offer from Paramount Skydance, Netflix will collect $2.8 billion in a breakup fee. Capital it can now redirect towards content buybacks or balance sheet strain. That restraint is exactly what investors wanted. Plus, Warner Brothers Discovery and Paramount are going to have to go through a 6-month to 12-month period to see if it's a monopoly and or not. I think the Trump administration might push that deal through pretty quickly. When Netflix originally bid roughly $82 billion for Warner's studio and streaming assets, investors balked. The deal valued Warner at 25 times projected 2026 EBITDA. That was rich compared with other media peers like Walt Disney, trading closer to 10 times. Netflix would have absorbed $50 billion in debt. Share repurchases likely would have been paused. The clean, capital light streaming story would have shifted towards a leveraged media conglomerate risk. Stock fell, but when the deal was called off, the stock roared right back. Co-CEO Ted Sarandos made clear the decision was financial, not emotional. It'll be interesting to see how this affects the November elections, especially with CNN content. I, for one, am glad that this deal fell apart. It's a referendum on capital allocation and discipline in media. Streaming scale no longer justifies any price. Debt-fueled empire building is out. And free cash flow and shareholder returns are back in. Netflix didn't lose Warner Brothers. It won back the narrative.
Retirement planning is more complicated than ever, and it can be hard to even know where to begin. So set aside March 11th, Wednesday evening, 6:30 p.m., and get ready to learn some strategies from Stephanie Richman, Rob Black, and Nathan Rogers that can help you retire better and pass on your estate while navigating wealth in uncertain times. That's March 11th at the Lafayette Library in Lafayette. The event runs from 6:30 to 8:30 and will focus on retirement income, tax strategies, estate planning, and tax planning. If you're nearing or you're now in retirement and have at least $500,000 in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves. Also, Social Security strategies and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. Navigating wealth in uncertain times is appropriate for individuals with at least $500,000 and either in or heading to retirement. Wednesday, March 11th, 6:30 to 8:30 at the Lafayette Library in Lafayette. Sign up for the event at robblackshow.com.
Markets are close to all-time highs, but this morning, a piece by UBS downgrading the stock market in the United States. Let's see what is causing worry at the investment bank, UBS. Their top equity strategist, he dialed back his view on U.S. stocks, citing mounting risks from a weakening dollar, stretched valuations, and policy turbulence in Washington. For retail investors, that's notable because UBS oversees and advises on trillions of dollars globally. When a firm of that scale shifts from overweight to neutral, it can influence institutional flows, pensions, sovereign wealth funds, global ETFs. Andrew Garthright, he's the head of global equity strategy at the investment bank. He downgraded American equities, the S&P 500 largely, to benchmark in a fully invested global equity portfolio, arguing that factors that powered years of outperformance are starting to fade. In plain English, the United States may no longer be the automatic default winner in global portfolios, which it has been for more than a decade. It's simply been Buy America, particularly large cap tech, and you would outperform the rest of the world. In 2024 and 2025, investors in tech started to think about when are small caps, when are mid caps ever going to outperform, because it's been a long time. They've been outperforming. Same thing with international stocks. Now let's go further into that UBS commentary. The dollar risk. It's a central concern when you read the report. UBS forecasts the euro climbing to $1.22 by the end of the first quarter and sees asymmetric structural downside risks to the greenback, the dollar. A weaker dollar sounds abstract, but it does matter. When the dollar falls, foreign investors who own U.S. stocks, they see smaller returns once currency effects are factored in. That can reduce demand for U.S. equities. Maybe not aggressively, but it's reducing demand for U.S. equities on some level. Historically, when the dollar's trade-weighted index falls 10%, stocks in the United States underperform by roughly 4%. That's according to UBS. It's meaningful in a world where annual returns often average 7 to 10%, historically 7 to 10% on the S&P 500. Currency alone can wipe out nearly half a year's typical gains. The dollar index many investors watch is the US dollar index. It's ticker symbol DXY. It measures the greenback, the dollar, against a basket of major currencies. A prolonged slide in the DXY has often coincided with stronger relative performance in overseas markets. That's going to bring up a big question. What overseas markets do you want to focus on? Europe, Asia, Latin America, Africa? There's multiple ways to do it. I don't know enough about Latin America, South America, Africa. And I do know that Asia, fortunately and unfortunately, has exposure to China. And their government tends to sometimes change what they believe in capitalism and how it should be implemented. I should have mentioned Europe, I think, is a lot like the United States with half the valuations, but also half the capitalism. There's a global rotation that's already been happening in the stock market. We started seeing it in 2025, and it's continuing in 2026 aggressively. Foreign markets are trouncing the U.S. this year. The weaker dollar and cheaper valuations are drawing capital, sucking it out like a vacuum to overseas markets. The Morgan Stanley Country Index World, excluding the United States, has gained about 8% in 2026 compared with little change performance on the S&P 500. Japan's Nikkei 225 has rallied 17% year to date. The stocks Europe 600 is up 7%. That's a sharp rotation away from the U.S. equities. Are you only in big tech? Are you only in S&P 500? Stocks have struggled as investors fret about the potential downsides of artificial intelligence and the build out in the United States. Then we also are seeing persistent inflation in the United States. And again, that doesn't affect high income earners like myself. It affects middle class and lower income hard. Now we are in an election year. It's going to be a wild march to November. A lot of promises broken. AI spending so far has been enormous, hundreds of billions in capital expenditures across mega cap tech. But the concern is starting to creep in whether earnings growth can justify those investments if adoption slows or margins compress. This week we had Salesforce report earnings, and they were okay. Not great looking forward. We also had Jack Dorsey slashing 40% of his employees. It's another pillar of U.S. stock strength, corporate buybacks. They're also losing the edge. American companies have aggressively repurchased their own shares, shrinking share counts and boosting earnings per share, even when revenue was just modestly growing. The buyback yield in the United States is now roughly on par with global peers, eroding what had been a key support for earnings per share growth and investor flows. Now, again, this is a UBS report today. Get your hands on it if you can. They say that the combined shareholder yields from dividends and buybacks in the United States is now about half of that in Europe. It's no longer exceptional here in the United States. And that's been an important driver of funds flows, cash, into investments due to earnings per share and valuation expansion. Valuations add to the unease right now in the U.S. UBS calculates that the sector-adjusted price-to-earnings ratio for U.S. stocks is 35% above international peers versus an average premium of about 4% since 2010. So valuations are rich in America. Policy volatility under President Trump is another headwind. This year has brought shifts in tariff policy, proposals to cap credit card interest rates, potential limits on private equity investments in housing, renewed scrutiny of drug pricing, and suggestions to curb dividends and buybacks for defense companies. Do we expect all of that to happen? I don't. And do I feel some of it is politically motivated to try to get a populist president, his party reelected in the November elections? Even the hint of regulatory shifts can lower valuation multiples because investors demand a higher risk premium. So a little bit more on UBS. The strategist in his note stopped short of turning outright bearish. He said the U.S. economy and equities tend to benefit more than peers when markets are in early phases of a potential bubble. That's an important nuance. When risk appetite surges, capital typically flows first in the deepest, most liquid markets, and that's still the United States. The bank, UBS, also expects artificial intelligence adoption to outpace most other major regions, with the possible exception of China, helping sustain earnings growth across key industries. I want to throw down a little bit on China real quick. I had a conversation with a dear friend talking about how China's kicking our butt in number of engineers they're producing. And the United States is underperforming because we seem to be a litigious society with lawyers versus China, which is saying engineers. China's killing us in robots. If you see what fool PR stunts Elon Musk has to do with Tesla's robots, the Optimus. And they are PR stunts, sword fighting robots, showing them fall over and stand back up. They're getting the job done. We are not in the United States. But the U.S. remains dominant in cloud infrastructure, semiconductor design, and AI platform companies. Structural advantages that aren't easily replicated. EBS strategist Sean Simmons set a year-end price target of 7,500 for the S&P 500, compared with an average forecast from other strategists of around 76.29. It's not a crash call. It's a call for moderation and diversification. The U.S. may no longer be the only game in town, maybe for a year, maybe for 5 years, but it's played out over the last 9 months easily. Longer if you start factoring in some other parts of the world. And again, small cap, mid cap U.S. is very different than the valuations we're seeing come out of Europe, and the market returns out of Japan are stunning. Right now, valuations in the United States leave less margin for error. Diversification, which is geographically and sector-wise, it may matter more in the next 5 years than it did in the last 10. Oftentimes, I talk about how I have benefited as an investor, as a man who started an investment advisory firm, oddly because of the dot-com era in the 1990s, then because of terrorism in 2000, 9/11 pushed interest rates from where we are now to 3% and lower, which led to easy money in mortgage markets, led to easy money in financing to start up companies. Just be honest with what got you to where you are. U.S. dominance was the easy trade for the last decade. UBS is signaling that the next chapter may be more balanced and potentially more global. I like the research out of UBS this morning. If for nothing else, I don't want to be right. I want to know what's coming or what potentially is coming. Want to learn more about your retirement nest egg? What are you doing right? What are you doing wrong? Going to be doing a big event Wednesday, March 11th, 6:30 to 8:30 in Lafayette. CFP Stephanie Richman, myself, and Nathan Rogers from EP Wealth will be there to talk to you about what are you doing right? What are you doing wrong? What are we doing differently than what you may not be thinking about? Session helps you cut through the noise, translate what you're seeing in the market, and focus on decisions to support long-term planning to make sure you don't run out of money. Have a cohesive wealth strategy. Plus, you get a free preliminary plan, which is an amazing deal. All you got to do is upload some of your financial statements and taxes, and we're off and running and helping you see what you're doing and giving you projections of what you have and what you won't have. One day when you pass away, did you have enough to last till the day you die? Sign up for the event at robblackshow.com. That's robblackshow.com.
These days, retirement planning is more complicated than ever. So set aside Wednesday evening, March 11th, and get ready to learn some strategies for navigating wealth in uncertain times from Stephanie Richman, Rob Black, and Nathan Rogers. This event will focus on retirement income, tax strategies, estate planning, and tax planning. If you're at or near retirement with at least $500K in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves, Social Security strategies, and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. That's Wednesday, March 11th, 6:30 p.m. at the Lafayette Library in Lafayette. Space is limited, so sign up today at robblackshow.com. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
A little over a year ago, the markets in AI freaked out when China released a large language model that showed that it was cheaper and just as good, or close to just as good as a lot of the large language models being developed by OpenAI and others. Stock market tanked then, and then this week it tanked again on Monday. Both are important, as both bring in doubt and questions ultimately on valuations in AI and when the payoff's going to happen, if it's going to happen, and how long do we have to wait. There was a research report that had a doomsday feel to it. It was issued by Citrini Research. It was also co-written by an investor analyst, Alap Shah. It was 7,000 words. The 2028 Global Intelligence Crisis. It was framed as a report from the future specifically June 30th, 2028. Not that far away. It started with the idea of what if our AI bullishness continues to be right, and what if they're actually bearish? What follows is a scenario, not a prediction. It wasn't horrific. It was sole intent of the piece was to model a scenario that's been relatively underexplored in their own words. It was posted on Twitter. It got 25 million plus views. A little bit far-fetched for some people. Key aspects of the publication were AI replaces large segments of white-collar jobs as agentic software takes over tasks, from coding to legal and financial work. Some of the ramifications were implied to be huge. Like, airlines will see fewer business travelers, and airline stocks went down on that news. Another thrust of the report was consumer spending collapses because workforce earnings shrink as employment wanes, even though output and productivity rise. It would be the ghost GDP. National accounts still show huge output, but that output doesn't translate into income or spending. It circulates amongst AI owners and capital, not consumers. The articles imagine the U.S. employment above 10% and the S&P 500 down 38% by 2028. It sketched into a lot of things what are called feedback loops. Layoffs reduce spending, which weakens corporate revenues, which pushes more firms to automate, which deepens the slowdown. The authors explicitly say this is a scenario, not a literal forecast or prediction. It's framed in the highly credible macro style with specific industry anecdotes and detailed narrative hooks. This week was another week where the markets are struggling to price AI's long-term impact, creating volatility and delaying broad-based confidence in future earnings durability. Earnings growth for now remains strong, but surprise levels haven't been as strong on the upside. Companies across industries must prove AI enhances profitability rather than disrupts business models and compresses profit margins. So the year has seen some multiple compression to begin the year, thanks largely to the rollback in mega-cap stocks. Forward earnings has gone from 25.4 up, down 25.1. In other words, the multiples haven't come down that much. There were a couple other factors involved with NVIDIA's post-report decline this week. As was the case with Amazon's post-report decline, Microsoft's post-report decline, and declines in many stocks, either immediately after the reports or in subsequent weeks. Meta platforms, Tesla and Alphabet, all ring true to that problem. The problem for NVIDIA is that its results were too good. Investors appeared skeptical that NVIDIA could continue to deliver the same monstrous growth as it contends with the law of large numbers, budding competition, and potential scaling back of CapEx budgets by the hyperscalers. The hyperscalers faced investor backlash for investing too much in the AI build-out plans without a quantifiable pathway to meaningful returns on their investment. So where we're left now is the hyperscalers are going to have to prove that they are getting meaningful returns on their massive AI investments. Hardware companies that need memory are going to have to prove that the spike in memory cost is not adversely impacting their profit margins. Software companies are going to have to prove that they are not being disintermediated by AI tools. And same goes for logistics companies and financial services, and right on down the line. AI is a change agent, but it's unclear to what degree for just about every business out there. It's going to take some patience to watch things get sorted. I expect there'll be many twists and turns along the way, at least 2 big twists every year. Just don't expect any significant multiple expansion at this juncture when the AI plot twist is thickened for a second time in the year. Now, we've had negative commentary and market corrections, market rotations before. Citadel Securities took on that Citrini research and publicly dismantled the doomsday narrative. Citadel Securities did, arguing it misunderstands basic macro fundamentals and adoption curves of technology. Other economists have called out Citrini's research as more of an allegorical thought experiment rather than a rigorous economic forecasting, noting that productivity growth historically creates income, not collapse. Some strategists have pointed out that the AI adoption is still slow, costly and constrained by infrastructure, regulation, and real-world integration challenges, countering the idea of a rapid near-term collapse. Many experts see the memo as an interesting thought exercise, but not empirically grounded enough to be a reliable forecast, especially not one that should drive multiple trillion-dollar market moves. There's always fear and there's always greed out there. In 1956, we were fearing peak oil. In the 1970s, we were fearing global cooling, which was quite the opposite of global warming. That the cooling effects of aerosols or particles in the air would effectively block out the sun and orbital forcing, which is the effect on climate of changing the tilt of the Earth's axis. It got debunked. The Y2K bug, it didn't come about and destroy all computers in the world. Halley's Comets had a gas panic in 1910. A French astronomer, Camille Flammarion, is credited for creating the concern by suggesting that Earth would pass through the comet's tail and that there was a chance that cyanogen gas would impregnate the atmosphere and possibly snuff out all life on the planet. People were panic-stricken. They bought comet pills and gas masks. If you ever want to talk about how your retirement's going to look for the next 10, 20, maybe 30 years, come to the event, Lafayette, March 11th, 6:30 to 8:30.
Retirement planning is more complicated than ever, and it can be hard to even know where to begin. So set aside March 11th, Wednesday evening, 6:30 p.m., and get ready to learn some strategies from Stephanie Richman, Rob Black, and Nathan Rogers that can help you retire better and pass on your estate while navigating wealth in uncertain times. That's March 11th at the Lafayette Library in Lafayette. The event runs from 6:30 to 8:30 and will focus on retirement income, tax strategies, estate planning, and tax planning. If you're nearing or you're now in retirement and have at least $500,000 in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves. Also, Social Security strategies and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. Navigating wealth in uncertain times is appropriate for individuals with at least $500,000 and either in or heading to retirement. Wednesday, March 11th, 6:30 to 8:30 at the Lafayette Library in Lafayette. Sign up for the event at robblackshow.com.